Good evening, traders. Welcome to your 7-minute market update utilizing technical analysis to predict direction based on human emotion. Today is June 10th, 2012. Lots to talk about. Big move on Friday, so let's get started. This is the SPY, just ETF to track the S&P 500. And I just want to make mention that a lot of traders, unfortunately, when they saw this big move coming down on Thursday, they jumped on to the short side. And unfortunately, when you chase, and I always stress this, never chase in the market. And once you chase, a lot of the short players got caught with their pants down on Friday. I mean, it was just it was just a huge update for the SPY, and it was based on news. So that's something else that I'm going to get into as well. However, I just want to make mention that I know a lot of analysts out there are considering this a piercing pattern, and the piercing pattern basically is when the candle opens below the previous day's candle, but then closes above 50% of the previous day's candle. So let's take a closer look here. This is the piercing pattern that I'm talking about, and as you can see here, on Friday we opened below Thursday's candle, and then we closed above the 50% of Thursday's candle. We actually closed at about 75% of it. Okay, now that would be considered a piercing pattern only if it appeared here, down in this area here, where you have this bullish engulfing pattern. Okay, now bullish engulfing pattern is okay. This is not considered a chasing in the market because this is an actual reversal pattern. The pattern has completed, therefore you can jump on board to the long side. This is a piercing pattern. Piercing pattern is valid after a down move such as this one here. Right now, this piercing pattern, or so-called piercing patterns, which is what a lot of analysts are calling it, I don't know why, it's definitely not a piercing pattern. It's after an up move has happened. Okay, so you want to keep that in mind, that this is not a piercing pattern. However, this is showing a lot of strength in the market, but not enough strength to validate a piercing pattern or some sort of reversal like we have here. Like I really don't expect this move here that happened on this engulfing candle here, the same here, which would be all the way up here. I mean, that is possible, don't get me wrong. However, highly unlikely. Okay, now let's get back to why this move happened. So to my knowledge, what happened on Friday was just, news will always come out after the move has made in the markets. That's why technical analysis is so important, because you'll find the news after the move has already been made. So by the time you get the news, the move has already been made. It's too late. Okay, but basically what happened was Spain was already always saying, I don't need to borrow money, blah blah blah. Now they're actually going in and asking to borrow money, or to get more money, or to get some stimulus or whatever they want to call it. They're asking for 100 billion euros, which equates to about 125 billion US dollars. And apparently that traders like that kind of news. And so, but when you get news, when you get a move based on news, and then look at this volume. I mean, this volume was just not existent. So I mean, this to me does not validate this move. However, a move on low volume indicates a reversal in the shortcoming. It doesn't mean that it's going to reverse the very next day, but it means that a reversal is coming soon. So we had this huge so-called reversal here on low volume. That means we could actually hit this 135.44 level before we get a reversal. Now, interestingly enough, I actually have this 139.98 level above this 135.44. We could possibly get there. It really depends on how traders react to this news. Again, we use technical analysis to predict emotion. Okay, so if a lot of people are emotionally satisfied with this $125 billion thing for Spain, we could actually get up to this 139.98 level before we're coming back down. Do I think we're gonna get there? Well, it's hard to tell because we have so much ways more to go. But this 135.44 level, we have this calculated level here, we have this trend line from this pivot level here, we have this 136.10 Fibonacci 618 level, which I was telling you guys earlier, which is the most powerful level of the Fibonacci retracements. In addition to that, and most importantly, we have this 50 moving average coming right into this 135.44. So we could potentially get up to this 135.44 and then come right back down. Now, a lot of times when traders when you see technical analysis, when you see a spike based on news, and especially on low volume, a lot of times shortly thereafter we get a reversal pattern. Now, it would make sense that we get a reversal right at just 135.44. We're currently sitting pretty at 133.1 or 133.10, so that's pretty much only a $2 move or a $3 move before we get on into this 135.89 level. Okay, so just keep that in mind, that we may get a bounce here. Now, I'm going to throw in some caveats a little later after I do my analysis on both the dollar and the VIX. So let's get to that. Oh, one more thing that I wanted to show you on the SPY that's very important is we look at the hourly chart. Let's take a quick look at the hourly chart here, and then we'll see a bunch of new data that I never seen earlier, or I never spotted earlier, and maybe I should have. Alright, so let me delete all my drawings here so I can kind of show you guys what I'm looking at. Now this line up here, this is called a misprint, or some call it a fake print. Okay, this is not an actual this for this time for the hourly chart did not actually happen. Okay, so but it is common that we do get a bounce off of this level here, which is around interestingly enough 135.69. Okay, well, let's get the exact number. The top here is 135.71, which is pretty close to my mathematically calculated level and all the other stuff. So it does make sense that we get that would be a strong resistance line. We would definitely get an intraday bounce off of that. I have no question about it. But would we continue higher to the 139 level? That remains to be seen, depending on what the pattern looks like when that day comes. Now, if I draw a line from the very top here with this fake print here, you can see that we just tagged that level on Friday. Okay, so there's a possibility that we could get a bounce off of that. All right, possibility, but not a probability. Okay, and the reason why is because you can also draw a trend line here, matching up these levels here. Well, actually, I'm sorry, right here, because before this area here, let me get rid of this line. Before this area here, we didn't know about any of this. So if we drew the trend line, right, all you need is 2 pivot points. We got a pivot point up here is 1, and we have a pivot point down here. So if we just draw it straight through this way, you'll see that we've actually, and this is, again, this here is the fake print. This actually didn't happen that at that time. All right. So as you can see, we came down and we actually broke through, right? And then most commonly, like I said, after we break through any trend line, we get at least a 50% retracement back to the upper trend line here, which is basically what it did. We had an idea that it would probably bounce off this 20 moving average, and this is the hourly chart, just to remind you guys. And then now we're bouncing up to make higher highs before we get a bounce up here, which is the 135 level. Okay, so could we get a bounce off this 200 moving average first before coming back down? Sure. Okay, but again, I'm gonna throw in some caveats now. Okay, so let me just continue on with the dollar. So with the trend line on the hourly chart, we have two levels, two possible trend lines here, and this is why technical analysis isn't as easy as what a lot of people say or think, because if you have multiple ways of drawing a trend line, then now you're in a 50-50 in a 50% level, and that's gambling, in my opinion. 50-50. So we need to find more validation of what the market could do tomorrow. I like this trend line better, even though this is a fake print. However, the caveats will tell us that there is more than likely it's more than likely that this is going to be the trend line here. And actually, if we move this up a little bit here, no, that wouldn't work anyway. All right, so on to the dollar. Alright, so now on the dollar, in the previous videos I said, again, I'm just going to go back in history just for new people who are just watching this video. I have a level here for the dollar at 85.23. Alright, and I also have this, I said that this level would be a pretty strong resistance point. Sure enough, we got that bounce. I said this would be what previous resistance point is now support. We would get a bounce off of that because of this 20 moving average. So that's exactly what we did. We pushed through the 20 moving average and went into the support line, and then we got a bounce. However, notice this candle here. A lot of people are calling this candle a shooting star. I really don't know why analysts are calling this a shooting star. Shooting star happens after an uptrend. So if this candle here was up here, then it would be considered a shooting star. So what is this candle? All this candle is saying that is that the dollar is pulling back because it's losing value. And like everybody knows, when the dollar's up, market's down, and when the dollar's down, market's up. However, we are holding this 20 moving average, but the caveats will say that there is a possibility that the dollar can move down to this 50 moving average, which would technically make some sense. Now I have some more drawings here that will indicate that this level here, I know it's hard to see with a lot of lines, but from this pivot point here and this 50% Fibonacci retracement, as well as this 50 moving average coming right up into this level here, this would be a pretty strong support level here if the dollar can break through that 20 moving average. So this pivot point here is something that we want to keep an eye on. All right, now if this coincides with the 135 level of the SPY, then we should get a significant bounce off the dollar, in which case will drive a lot of pressure onto the SPY and should bring the SPY down. All right. Now let's take a look at the VIX. This is a daily chart of the VIX. Let me load my drawings here. Now the VIX did what it did what I said in the previous video. Is in this rising channel here, we broke down, but we did not confirm. You notice we did not confirm the VIX down here. We actually we opened here, we came up, we came back down, and then we came back up again, right? Where did we go? Right on this trend line here to have a retest. Okay, so could the VIX go higher? Yes, it could go higher because we didn't confirm down here, but chances are the VIX would probably go lower based on the caveats that I'm going to explain after this VIX chart here. I do have a level here of 1949, and you have this 50 moving average here with this gap fill here. So this is a lot of support. Okay, so the VIX would take a lot for the VIX to come through here. It would be a lot of technical damage before the VIX gets down there. Then your next support levels will be here. I didn't calculate any mathematical calculations anything below 1949, simply because I don't know if it's going to get there. If we can get past the 1949 level, then I'll make more calculations. But manually drawn, these are your support levels on the VIX. Okay. So now to the caveats. All right, so next week, as I explained in the previous video, is options expiration week, which means Friday of next week is when all options for June expire. And what a lot of institutions like to do, like big hedge funds and all and whatnot, what they like to do is they like to it's gonna be a very volatile week, or 90% of the time during options expiration, that week is very volatile. And what a lot of institutions like to do is they like to spike the market to get all the puts stopping out, and they drop the market to get all the calls stopping out and whatnot. So a lot of times, a lot of ways, I mean, it doesn't happen all the time, but a good percentage of the time, or more than not, meaning more than 50% of the time, if there's a lot of puts in the market, meaning a lot of people are holding puts, a lot of open interest in puts, or a lot of there's a lot of puts, people who are short the market, then what institutions like to do is they like to prop the market higher. They like to go high in the market because if there's more puts than calls, then obviously they're going to lose more money if they don't prop the market higher. After options expiration week is done, then they'll drop the market, or they'll let the market do what it needs to do, and then and then so on and so on. So every third Friday of every month, that week is going to be options expiration. And what happens is, if there's a lot of calls being bought, then the institutions will drive the market down to get everybody out of their calls, meaning their contracts will expire worthless. Okay, that's basically the bottom line. Now in this market today, right now, on the SPY, because it's the ETF that tracks the S&P 500, and you'll see a lot of volatility in a lot of different stocks. A lot of stocks may or may not actually follow the SPY, because a lot of institutions, there's going to be a lot of game playing. Okay, so right now there's I don't know what the ratio is, but there's a hell of a lot more of puts being bought than there are calls, right? So if there's a lot of puts being bought, then institutions are going to want to drive the market higher. Okay, they're gonna, a lot of times what they do is, if they don't have enough money to drive the markets higher, then what they do is they release news, or rumors. Rumors are the biggest one. When you have rumors, the market spikes and then just drops right back down. I mean, obviously everybody sees that all the time. That always happens. So that's one of the caveats. The caveat is next week is options expiration week. It really depends on what the institutions want to do. More than likely, they'll drive the markets higher simply because there's a lot more puts than there are calls. It doesn't happen all the time, but you see it happen more than not. Okay, so they always go opposite of what the general population is thinking, right? So if everybody is along the market, then the institutions are going to drop the market simply because they want your options to expire worthless, simply because they're the ones who are writing the contracts for you to buy. Okay, so here's another caveat. Another caveat is stock pinning. A lot of times there's an anomaly where people's strategies with their condors and all that other option strategies all end up after all is said and done, there's this thing called stock pinning, where the actual price pins to a strike price on a specific stock or market. Okay, and a lot of people have mathematical equations for those. I haven't really gotten into that yet, but there's a way where you can figure out more than likely where that number is going to be, or what that strike price is going to be, and then that will help you determine where the institutions are going to take to the market. But just imagine that if you have stops in place, which you should abide by your stops, and most people do have stops, and then if you're going to get whipsawed, you're going to have a lot of head fakes, you're going to have a lot of rumors coming out. I mean, that's just what happens during options expiration week. Okay, so you just got to keep that in mind. That is a caveat. And in addition to that, Spain did get an approval just recently, I think it was yesterday, that they will be getting 125 billion US and 100 billion euros or something like that. Basically, they got approval to get that borrowed money. And the market's like that because now the Europe situation is decreasing, so fear is going to definitely decrease as well. And if fear decreases, the VIX goes down and the market would definitely go up, right? And then vice versa, the dollar will weaken and then the markets will go up at the same time. Okay. But a lot of times, rumors and stuff like this, a lot of times prices are already fixed, priced into the stock or priced into the market. So it's going to be short lived. A lot of times, because it's short lived, it would make sense that if we get to this 135 level, this 135.44, then we may actually get, a pullback, and that pullback is going to make a lower low, you know, I haven't calculated the how low it is until we get an actual reversal. Then I can calculate what the next low will be. But right now I have a calculation of 135.44 and 139.88 and 98, and that's pretty much it. So if we do get a rally on Monday, then keep your eye on 135.44 at least for an intraday trade. Okay, at very minimum, I would take that as an intraday trade. Now here's a couple of things that we're gonna do tomorrow. If we do rally over, and what you can do is keep an eye on the E-mini futures. Okay, if we rally on the E-mini futures and we're up, say, I don't know, 20, 30, or $50, for that matter, you can pretty much gauge what the SPY will be doing. You just minus two zeros, and then you can kind of see, because the SPY, the E-mini futures, the S&P E-mini futures, tracks is like it's contracts for S&P. So if you think about it, the SPY is times 10 the E-mini futures. So you can pretty much guess where the SPY is going to open the next day based on looking at the E-mini futures. Now, if we gap right into this 135.44 level, then I would probably already take a short. Okay. And obviously my stop is going to be anything above the 50 moving average. And I'm just going to have to wait for all the head fakes and stuff like that. Unfortunately, this pattern actually, or this news actually, is happening on the week of options expiration. So therefore, anything can happen. Okay. Now, I don't know if we're gonna get all the way up there. However, if we gap, say, lower, and then we gap into this 135.44 level, I mean, we gap a little lower than the 135.44, and then we drive price all the way up into this 135.44, then I'll still take a short. The only time I won't take a short is if we gap, say, above this 135.44. If we gap above this 135.44, this is considered a runaway gap, and I wouldn't doubt we get at least to this 75 percent Fibonacci retracement, and then a 139.98 is a possibility after that. Okay, so that's something that we're just gonna have to keep an eye on. So right now, staying in cash is probably a good idea, in my opinion. Okay, so now let's just say that we're neutral to bullish, in a neutral to bullish standpoint here. If the price hasn't been already if the stock hasn't already, or this ETF hasn't already been priced in for this this Spain bailout, then we should have continued upside, right? So based on that, let's take a look at some stock. All right, so let's look at some big stocks and some medium-sized stocks. So the first stock I want to talk about is Apple. Everybody wants to know about Apple. We have a level here which is about 590 or so. This level right here, this is a manually drawn level off of this pivot point. Is it going to be strong resistance? Is possible. I may take that as a day trade. We're already into this 50 moving average, and we pushed to this 576.67. So this level here is no longer valid. In fact, I should delete that after. And the only reason why I think this 576.67 would be a good support, right? But the only reason why I think it's no longer valid is because we already came into this 576.67 calculated level and we got that bounce, okay? So we're at 576.67. The low of this candle went all the way down to 570.5, which is a $6 drop. We went right back into this. The high of the candle is just 576.50, right? And then came right back down. The low of this candle was 569. So basically, this level has been hit 3 times already before we broke out. All right, so this is an intraday level. I'm gonna take that out already, and then let's look at the daily again. All right, now we have this the daily chart. Let me just zoom in here. At the next level is 607.62, right? Now based on Apple can move literally, right now the ATR is at 14.54, but I've seen Apple move, $20-30 in a single day. That's definitely possible, and this falls around that range. This would be see, Friday it closed at 580, so 607 would be $27, right? Approximately, give or take a few cents. So $27 upside in Apple, if we can get there in a single day. And again, before I make a swing trade, I always look at the intraday hourly chart or half an hour chart, and I always try to pick the when it looks like it's going to reverse. If it doesn't look like it's going to reverse and it's still bullish, say on the hourly early, then I won't take the trade. I'll wait, because sometimes stocks are just so strong, which I'm about to show you on Walmart. It'll just pierce through my level, and in which case we'll have to wait for the next one. Okay, and that's how these levels work. If it pierces through the level and it looks strong, I mean, if it looks like it's going to be a reversal on the hourly chart and it hits my level, then I'll take the short. If not, then I let it break through, because no level is going to be 100% guarantee, right? I mean, just calculated levels have been working out pretty good for me, but no level is going to be 100% guarantee. You're always going to fall within that 10%. I mean, 90% of the time these things work. You're always going to fall into that 10% time where it isn't going to work, and those are the times that you want to stay away from, because those are the times that you will lose money. But right now I have an upside of 607.62 for Apple before we get at least an intraday bounce or a reversal. Okay, so keep an eye on that. Again, make sure that you look at your intraday before you actually take the trade. Alright, this is a chart of ABX. I'm really keeping an eye on this chart because I really like the way the chart looks. It really depends on what happens on Monday, though. Again, don't take the trade unless the hourly says that it looks good, right? Or at least a half an hour. Okay. I really don't like to look at the hourly chart, to be honest, because the markets are open 7.5 hours, so you're gonna have half an hour, a candle that's created just in half an hour, not an hour, so you're not getting the full, candle. So a lot of times I like to look at the half an hour. Okay, I do have a level here. Let me just move this. I think I mentioned this in the previous videos, but I have 3690, okay, as a support level. Okay, let me just move this back into place again, and it just so happens to fall in the 75 retrace of the Fibonacci. And again, we have this level here from the rising channel that I normally get breakout levels here, all the way down to the same exact area, which is right here. So this is telling me, at least for intraday, this is going to be pretty good support. We did get an update on Friday as well, because it increased with the markets, and this is a mining stock. Okay, so it really depends if you can even get here anyway to begin with. If we can't even get there, then no big deal. Do I have a shorting level here yet? No, I haven't made a calculation for a short yet for ABX, but maybe I'll do that in the next video. Okay. This is a chart of Amazon. So Amazon, I had a level at 222.70. It came close. I mean, we got up to 221.49, so that's about a little less than $1 off. But with an ATR of 550, that's not so bad. But I missed this level, not a big deal. You missed the level, don't take the trade, and don't chase either. Okay, so let's just say we do get an update on Monday. If we do get an update, again, keep an eye on the E-mini futures, because that will give you a really good idea of what the market's going to open at the next day. But I do have another level here, believe it or not, 240.70. Again, I don't make up these numbers. It's just a mathematical calculation that I put in the data, and it spits out a number, and this is the number, which is 240.7. Okay, and then of course a pretty good support level, which is at 197.73. I doubt we get there anytime soon. We're gonna get a pop in the market first. We're also gonna have resistance here. Right, these are pivot tops, so this is going to be pretty good resistance here. After that, we're going to have a double top resistance here, at least for an intraday at very minimum, and then the 240.70 level. Let me see if there's anything else back here at 240.70. Yeah, there you go. So perfect. So actually, I really like this 240.70 level. If it ever gets into the 240.70 level, then that's a dead short in my opinion. Okay. This is a chart of Caterpillar. Okay, right now I have these levels here, which is 88.64. We actually pierced through 88.64, and then we did drop, so this level is no longer valid. We have this 92.48 level. I don't know if we, I don't know if we get a bounce off this 92.48. It really depends on the pattern, but I really like this level here, which is the 96.15 level. If it gets there, then a short can be taken. And the reason why I like this is because we're right into this 200 moving average. The 50 moving average is coming down. We're right at a 382 Fibonacci level. I mean, even though we get a bounce off of this 92.48 level, the real bounce, if it gets there, which is 96.15, is where I would want to take the short. Okay. This is a chart of American Express. Three-letter code is AXP. I have a calculator here at 57. A calculation here at 57.27, which just so happens to line up almost perfectly with this 50% Fibonacci retracement. Okay, and we have this 50 moving average here. We do have a 618 here, so there is a possibility that we can get up to 58.24. Again, it depends on the intraday pattern. But we also have this pivot point here. We have this 50 moving average. I mean, I think this is going to be pretty good resistance here. I may actually take a trade on AXP. We're also in a downtrend, so taking a short position on this would be okay. Now, just keep in mind, next week is options expiration. So if the perfect thing for me, in my opinion, is if we reach these levels that I'm talking about now in all these stocks on, say, Friday. If we reach these levels on Friday, then that'll be a perfect short in my opinion. And the reason why it would be a good short, in my opinion, is because options expiration will be done, and then next week the institutions will just let the markets do what it needs to do, and then it'll pull back. Now, if we reach this level, say tomorrow, then I may have to reevaluate and maybe take the next level higher. Okay. Especially now with options expiration, it's all about timing. You want to make sure. I mean, if it reaches the level on Thursday, then I might even still take the short. But if it's in the beginning of the week and it gets there too fast, then I may not take the short. And it's simply because there's so many puts in the market right now. Institutions are going to try and drive it the opposite way. Plus, too, we have this Euro news. I mean, it just gives it even more of a chance of the markets going higher. Again, we need to watch the E-mini futures to see what the emotional standpoint is in the general population of trading, and then it'll give us a good idea of what the markets are going to do tomorrow. Not what it's going to do throughout the day tomorrow, but where at least it's going to open tomorrow. Okay. And then from there, we can look at the E-mini futures pattern to dictate what the possibility of the next move might be, either up or down, or vice versa, or maybe even sideways. Okay. Last but not least, this is a chart of BIDU. So my calculated level here is at 125.01. The top of this candle was 124.80. I was off, but it's too close to this calculated level. Okay, so this one is no longer valid. I'm going to delete it later. The next level I have here is 131.25. I really like this level again because we have this 50 moving average coming into this 200 moving average. Okay, and then we also have this calculated level, and I don't know if there's a Fibonacci. There's a Fibonacci level here, which is at the 50%. So anywhere around this area right here would be a good shorting level, in my opinion, for BIDU. And then of course we have the next level, which is 138.08, and a Fibonacci level of 137.23. So around this area too would also be a good shorting level. And then we have this gap window here. Do we get up there? It's anything's possible, but I don't really think so, because there's nothing right now that's telling me that there's a change in trend. All it's telling me right now that is this move is being based on news, and a lot of times when you have moves based on news, it really doesn't validate it, and then the markets will turn around shortly. Okay. So that's about it. I mean, again, you just want to make sure that these levels are hit towards the end of the week. You really don't, in my opinion, I really try to stay away from swing trading during the week of options expiration because it's so volatile. But I do like to day trade because day trading is a lot more fun because it's a lot more volatile. However, just keep in mind, levels aren't hit to the penny during options expirations, because again, there's a lot of game playing, so they're gonna make it like, oh, I almost get there, and then the institutions will go psych and then pull it back. That's what they do. That's the kind of games they play, because they know how most people do technical analysis. Now these calculated levels, however, nobody knows about. These calculated levels were invented by me. I discovered it the ending of last year. Nobody else has this mathematical calculation but me. Okay, so that's one advantage that I have, and I like it when they match up with other indicators like moving averages and Fibonacci levels, and it just validates that even more for me. Okay. And another key thing is don't chase. Okay, that's absolutely not what you want to do. If we get an update tomorrow, you don't want to jump onto the long side. You just wait. You wait for a pattern. You wait for the pullback. You wait for the consolidation period before you jump in to the long side again, or you wait for a reversal before you jump into the short side. Okay, rules are rules, and it'll help you stay away from losing money. Okay. And then last but not least, you always want to abide by your stops. You always abide by your stops, and you always want to take your stops as close as possible. I mean, your entry has to be as close to your stop as possible, especially when you play options. That way you lose very minimum amount of money, because options you can lose 50% in a single hour. I mean, it can happen that fast. All right, so thank you very much for watching this video. God bless to you all. Good luck to you next week. Hopefully I can keep you guys updated on a daily basis next week as to what it looks like and what things are doing. Keep an eye on the E-mini futures, and you all have a nice weekend, and I'll see you in the next video.